Every development deal we put together at Gooden Development follows an exact structure. The capital stack, the debt, the equity, and how investor returns actually get paid out. If you've ever wondered what it looks like from the inside, I'm going to walk you through exactly how we structure our deals, and I'm also going to use some real-world examples from projects I've actually done, so this isn't just theory. Welcome back to my channel. If you're new here, my name is Justin Gooden. I'm the founder of Gooden Development. We build Class A multifamily communities from the ground up here in Indiana. And this channel is where I document the whole process, the numbers, the structure, and things most developers keep to themselves. So let's get right into it. When we put a development deal together, we're not just building apartments. We're building an investment vehicle, and that vehicle has a very particular structure that determines who puts money in, who takes on risk, and how everyone gets paid in the end. This is called a syndication, which is really just a fancy word for pooling capital from multiple investors to fund a single project. My role as the developer is to find a well-located site, put the deal together, and manage the entire development process from start to finish. The investors come in as limited partners, meaning they're completely passive. They don't make decisions, they don't manage contractors, or deal with any tenants. These are busy professionals, doctors, or business owners, people who want the financial benefits of real estate without the headaches of being a landlord. They invest their capital and participate in the upside. Now here's where it gets interesting, because not all capital in a deal is the same. Every deal we structure has what's called a capital stack. And the easiest way to think about this is it has layers. At the bottom, you have the debt, which is typically a construction loan from a bank or lender. On a deal like the Elwood, which is our $26 million project in Kokomo, Indiana, we worked with a local bank for that construction loan. With the debt being at the bottom of the capital stack, the bank is in the safest position since they get paid back first. Above the debt is the equity, which is where our investors and I sit. Equity carries more risk, but it's also in the position that has the highest potential returns. So for the Elwood, we raised $5.5 million of capital from 46 limited partners to fund the equity portion needed. The way we split that equity is through what's called a waterfall structure. And this is the part most passive investors don't fully understand going in. A waterfall is just a fancy term for the order in which profits are distributed in the partnership. Think of it like an actual waterfall. Water flows down in a defined order. It fills the first pool before it spills onto the next one. Profits in a syndication work the same way. Here's how it works. When cash starts flowing in, whether from a sale, a refinance, or distributions along the way, investors get paid through what's called a preferred return. Within our projects, that's typically between 6 and 8%. What that means practically is that before I make a dollar profit as the developer, investors are earning that return on their capital first. Okay, so once that preferred return is met, we move into the profit split. Our typical structure is 70-30, meaning 70% of the profits above that preferred return go to investors and 30% goes to the developer or sponsor team. And remember when I said a waterfall fills one pool before it moves on to the next? Some deals include a second hurdle, sometimes even 3 or 4 hurdles. This means once investors hit a certain overall return threshold, sometimes like an 18% IRR, the split can shift again to reward the developer for performance, something like a 60-40 or 50-50 split. IRR stands for internal rate of return, and it accounts for the timing of cash flows, not just the raw dollar return. This is how sophisticated investors actually compare different deals, and it's how we present our projections. And honestly, if investors on a ground-up development deal are clearing above and beyond an 18% IRR, everybody is winning. By having that waterfall in place, it can incentivize the developer to perform. The last piece is the hold period. On our projects, we are typically projecting a 3 to 5 year hold period from the time we break ground to the time we sell. Now, of course, that hold period could be more or less depending on what is happening with the market conditions. As developers, we never want to sell in a down market and put our investors' returns at risk. On the Elwood, we're projecting a 3-year hold period total from the time we broke ground to the time we go to sell the project. So development is not a short game. And that timeline is just the nature of building something from the ground up. But when the deal is structured correctly, the wait can be worth it. And that's the typical structure for our deals at Gooden Development. We build our capital stack with debt and equity, always give investors a preferred return, have a waterfall structure in place, and project a 3 to 5 year hold period for all of our projects. It's not complicated once you see it laid out, but understanding the structure before you invest is what helps you become an informed investor. If you have questions about any of this, drop them down below in the comments. You can also visit goodendevelopment.com/course and check out our free 7-day passive real estate investing 101 email course. If you got value from this, make sure to like and subscribe, and I'll see you on the next one.